On Thursday, August 21st, 2025, European financial centers opened to a rare stillness. Trading screens in London, Frankfurt, and Paris barely flickered. Major indices moved by just fractions of a percent. This wasn't apathy, it was anticipation. Investors everywhere were fixated on the upcoming Jackson Hole Economic Symposium in Wyoming. The usual market drivers, earnings, economic data, were overshadowed by the looming event. Traders hesitated, unwilling to make big moves before hearing from the world's top central bankers. The morning's flat performance was less about current events and more about waiting for the signals that would shape the months ahead. Until the symposium began, Europe's markets were content to hold their breath. Each year, the quiet mountain town of Jackson Hole, Wyoming, transforms into the epicenter of global finance. Nestled among breathtaking peaks and wide-open skies, this picturesque setting becomes the unlikely stage for some of the world's most consequential economic discussions. The Jackson Hole Economic Symposium, hosted by the Kansas City Federal Reserve, draws central bankers, finance ministers, and top economists from every corner of the globe. For a few days each August, the world's financial elite gather here, far from the bustle of Wall Street or the political intrigue of Washington, D.C. But make no mistake, this is no vacation. Behind closed doors and in packed conference rooms, high-stakes debates unfold. Here, the future of monetary policy is often hinted at, debated, or even announced, with every word weighed carefully by markets and governments alike. This year, the spotlight was firmly on U.S. Federal Reserve Chairman Jerome Powell, joined by Christine Lagarde of the European Central Bank and Andrew Bailey of the Bank of England. Their presence underscored the global importance of the event as their decisions ripple through economies worldwide. The world's financial markets hang on their every word. Investors, traders, and analysts parse each speech and statement for subtle clues about the direction of interest rates, inflation, and the broader economic outlook. A single phrase can send markets soaring or tumbling within minutes. Over the years, the symposium has become legendary for its role in signaling major policy shifts, from the announcement of new economic frameworks to the unveiling of crisis-fighting strategies. Jackson Hole's history is rich with moments that have shaped the global financial landscape. Investors know that a hawkish tone from central bankers could send stocks tumbling, while even the slightest dovish hint might spark a rally. The stakes are enormous, and the mood in financial centers around the world is often tense as the symposium unfolds. With the global economy at a crossroads, facing inflation, geopolitical tensions, and uncertain growth, the anticipation this year was higher than ever. Every participant, from seasoned policymakers to young analysts, felt the weight of the moment. Jackson Hole wasn't just another meeting on the calendar. It was the birthplace of the next wave of global economic policy, where decisions made in the mountains would echo across continents and shape the future for billions. The spotlight was on Jerome Powell, the man whose every word can send shockwaves through the financial world. As chair of the U.S. Federal Reserve, Powell's influence extends far beyond Washington, shaping the direction of economies and markets across the globe. Investors, analysts, and policymakers alike waited anxiously for his next move, knowing that the fate of interest rates and perhaps the global recovery rested in his hands. His statements have the power to shift global markets in seconds, triggering rallies or sell-offs from New York to Tokyo. This year's speech at the Jackson Hole Economic Symposium carried even more weight than usual. Rumored to be his last appearance at this iconic gathering, it was a pivotal moment to define his legacy as Fed chair. Investors around the world were desperate for clarity. Would Powell hint at a new direction for monetary policy or stick to the cautious path that's defined his tenure? The big question: would Powell signal a pivot from high interest rates to long-awaited cuts? Or would he keep rates elevated to fight inflation? Recent U.S. economic data showed signs of a cooling economy, slower job growth, softer consumer spending, and easing inflation, all fueling speculation that a rate cut could come as soon as September. The possibility of a rate cut sent ripples through financial circles, with economists and traders debating the timing and impact of the Fed's next move. The Fed's decisions don't just affect the U.S., they ripple worldwide, influencing currencies, investments, and economic growth from Europe to Asia. A rate cut would likely weaken the dollar, making U.S. exports more competitive and boosting investment in other markets, especially in Europe and emerging economies. European stocks in particular were just as invested in Powell's message as Wall Street, with investors hoping for a boost to global growth. Powell faced a delicate balancing act. He needed to reassure markets that inflation was under control, while avoiding any hint that could reignite price pressures. The challenge was clear: signal confidence in the Fed's progress against inflation, but not so much optimism that markets overheat. Consumers too were watching, hoping for relief from rising prices, but wary of any moves that might threaten the fragile recovery. Every phrase, every pause in Powell's speech would be dissected for hints. Was he sounding dovish, signaling easier policy, or hawkish, warning of more tightening ahead? The answer would set the tone for global markets for weeks, if not months to come, shaping investment decisions and economic forecasts worldwide. As the world watched, all eyes were on Jackson Hole, waiting for Powell to reveal the Fed's next move. Hopes for a US rate cut were grounded in real data, not just wishful thinking. Investors and analysts alike had been scouring every economic indicator, searching for signs that the Federal Reserve might finally ease its policy. The anticipation was palpable, as each new report had the potential to shift market sentiment dramatically. A soft US payrolls report signaled a cooling job market, reducing inflation risks and boosting expectations for a Fed pivot. The numbers showed hiring was slowing, wage growth was moderating, and the labor market was no longer running as hot as before. For many, this was the clearest sign yet that the Fed's aggressive rate hikes were having their intended effect. By the eve of Jackson Hole, markets priced in an 80% chance of a September rate cut. Yet caution lingered. Investors remembered previous false dawns when hopes for easier policy were dashed by a sudden rebound in inflation or a hawkish Fed statement. The odds had slipped from 84% the day before, reflecting doubts about whether 1 month of soft data was enough. Some wondered if the Fed would need to see a longer trend before making such a pivotal decision. The Fed is famously data-dependent, and some officials might want more evidence before cutting rates. They have repeatedly emphasized the need for sustained progress on inflation and stability in the job market before making any moves. Investors were caught between optimism and prudence, waiting for Powell's definitive signal. Some were eager to act, while others preferred to wait, wary of being caught on the wrong side of a sudden policy shift. The market's fragile equilibrium reflected this tension, hopeful but braced for disappointment. Every tick of the clock brought new speculation, and every headline was dissected for clues. Until Powell spoke, no one wanted to make a bold move. The uncertainty kept trading volumes low and volatility high, as everyone waited for the Fed chair's words to break the deadlock. The world was in a holding pattern, with markets, policymakers, and ordinary people all watching and waiting for the next chapter in the story of interest rates. While the US dominated headlines, fresh economic data from Europe offered a snapshot of its own recovery. August's flash PMI figures showed France stabilizing after months of weakness. The services PMI rose to 49.7, still contracting, but the best in a year. Manufacturing nearly hit expansion at 49.9. These numbers suggested France's downturn was easing, fueling cautious optimism for the Eurozone. For the ECB, signs of stabilization meant less pressure to cut rates, but also confidence that the economy could withstand current levels. Investors watched for similar trends in Germany and the UK, hoping France's improvement wasn't an outlier. A broad-based recovery would lift European assets, but weakness in Germany could overshadow French gains. The mixed data kept markets indecisive, mirroring the global uncertainty. Europe's economic story was still unfolding. Beyond the big picture data, company news shaped the day's trading. In the UK, WH Smith shocked investors by lowering its profit outlook after uncovering overstated earnings in North America. The accounting issue spooked the market, highlighting operational risks. Meanwhile, Dutch insurer Aegon reported a strong turnaround, doubling its share buyback and raising its dividend, signs of confidence and stability. UK engineering group Renishaw lifted its profit outlook, crediting swift cost-saving measures. In Finland, real estate firm Kojamo posted higher revenue but weaker profits due to property valuation losses, a reminder of sector-specific headwinds. These stories painted a mixed picture, some companies thriving through smart management, others struggling with industry challenges. The result was a market as indecisive as the macroeconomic backdrop. Strength and weakness coexisted, mirroring the broader uncertainty. Oil prices climbed on Thursday, offering another perspective on the global economy. Brent crude rose 0.8% to $67.37 a barrel. US WTI gained 1% to $63.33. The driver? Strong US demand. Crude stockpiles fell by 6 million barrels, gasoline by 2.7 million. This signaled robust summer travel and economic activity even amid slowdown fears. Rising oil prices can signal economic strength, but they also risk fueling inflation, the very problem central banks are fighting. For investors, oil's rally was a double-edged sword, a sign of resilience, but also a potential inflationary threat. Central bankers like Powell had to weigh these signals carefully. The oil market added another layer of complexity to the pre-symposium puzzle. Economic strength and inflation risk were now intertwined. Thursday's flat European markets reflected a tug-of-war between hope and caution. Optimism came from expectations of a Fed rate cut and better-than-expected French PMI data. Positive corporate news, like Aegon's results, added to the bullish case. But uncertainty loomed. No guarantee Powell would deliver the dovish message investors wanted. Mixed corporate news, such as W.H. Smith's profit warning, reminded everyone of ongoing risks. These crosscurrents cancelled each other out, leaving investors hesitant to take big positions. The logical move was to wait for clarity from Jackson Hole. The market's stillness was a mirror of global indecision. Everyone was poised for the main event. As Europe's trading day ended, markets remained in suspense, awaiting Jackson Hole's outcome. The real test would come after Powell's speech. Would he signal a rate cut or urge continued caution? A dovish pivot could spark a rally, making European stocks more attractive as global liquidity rises. A hawkish or non-committal message could trigger a sell-off, forcing investors to adjust to higher for longer rates. Ultimately, central bank policy overshadowed all other factors. The symposium held the key to the market's next move. Once the speeches ended, Europe would finally have a direction, one way or the other.